Hi, this is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Today, another day, another IPO. Confluent recently IPO'd in the last week. Ticker is CFLT. The question is it worthy of its current valuation? Is it an IPO worth considering or buying at this stage? Personally, I think there's huge downside, but first we're going to talk about their business model and then we'll talk about their valuation. Let's dive right in now, which is that, first of all, one should understand this isn't my first IPO video covering a stock where I think valuation is potentially too lofty. I talked about C3.ai or AI stock, which I said at the time that it went public. Pre-going public, I thought it would be cheap. Then it opened up way above the price that I was originally hoping for. And so I said, man, there's like 80% downside now. I mean, it literally was hundreds of percent higher than I originally expected and originally discussed at the time. Since then, since making this video, AI stock is down about 50%. And so this is a key theme that I think a lot of people need to understand, is that just because you find a great company doesn't mean that you can ignore valuation. Wake up, folks. Valuation matters, especially if you're potentially facing an environment of higher interest rates over time. So that is something you definitely want to consider. I made a whole separate video talking about Ray Dalio and the interest rate environment potentially impacting stocks. But that said, no matter what you own, you always want to consider valuation, because that is ultimately one of three key variables that drives your prospective investment returns over time. So let's actually dive into Confluent, so that way we understand what's going on here. That said, I did put out my warning on sort of saying, hey, I don't like the valuation here. That said, if you want to understand their business model, Confluent's business model, I'll talk about the business model now and their valuation in a bit. So the business model, once you understand that the current paradigm is about capturing data, storing it across various different sources, whether or not it's your on-premise servers or cloud solution, hybrid solutions. Then you take this data and you're querying it and then analyzing it. And so it's a very sort of human process. You take this data, query, analyze it. Whereas here it is, what Confluent's trying to do is sort of say, take this as a real-time data stream. And the founders here, they were originally working as part of LinkedIn when they built this, the leading open source offering for data in motion. That's the phrase they keep talking about, or streaming data, data in motion. Apache Kafka was originally created by our founders in LinkedIn in 2001, brought to the mainstream a new paradigm of data processing. So it's no longer about capturing it, storing it, then querying it. What if you just constantly have it flowing? So they felt like this is the new revolution. Instead of, hey, you query the data from yesterday and then run the process. No, let's have this constantly being processed, sort of like an analytics dashboard that you can see constantly being updated. And Confluent was founded to create a product that could make data in motion the central nervous system of every company in the world. So it's about real-time updates, a central nervous system. And what they mean by central nervous systems, at least in the words of the founder, is that it's all the different parts of a body in a coherent whole. So you're getting updates across a company, across all these different things, all these different solutions, whether or not it's a sale or shipment or customer experience. All of this data is coming into you real time and can be processed in a real time way. Oh, I could see what's going on in a real time way. And this is effectively an enhanced analytics platform for diverse data stores. So, you could have data all over the place. Maybe you have sales data, with Salesforce.com, and your customer experiences with Zendesk. And then you have, shipment data with, your logistics provider. Okay, you need to make sure all this data is coming together and being analyzed in a real-time way as these things happen. That's what's critical. And so you can understand why this is so key. For example, one company that uses Confluent is Advanced Auto Parts, which is they talk about in the case study, how does the largest automotive aftermarket parts provider in North America ensure the right parts from its 30,000 vendors are in stock for professional installers and yourself customers across all of its 5,200 stores. So you think about like, okay, you have your suppliers, you have your stores, you have shipping, logistics, you got to update all this in real time. And this is really the lifeblood of a retailer, because if you don't have that inventory on stock, that means you're not making sales. And that means you're not making profits. And that is the lifeblood of your business, those profits. So you need to make sure you have that inventory. This is key functionality for them. And what's interesting is it's not only about key functionality, is you start realizing that having real-time insights actually leads to better algorithms, better machine learning. For example, if you have, let's say, a fraud detection model that tracks payment, transfer, login, withdrawal information all at the same time. So as it happens, all these things could be transferred into different data silos. So by putting it all together so that you see this information as it happens, the AI models, the machine learning models can make better conclusions saying, oh, this happened at this time right after this, and therefore this is more likely to be fraudulent. So you can create better models ultimately for the company. That's why central nervous system is so important. Like this is key to the companies. It's not only key to how they operate, but key to how they improve. And it actually gets even better. And this is an aspect that makes Confluent stronger, and I'd argue gives them a very strong value proposition, which they talk about the adoption flywheel. Another way of describing it is a network effect. As more and more applications sort of connect with Confluent, whether or not it's your sales or your customer support or your logistics or inventory, whatever that data source is being connected to it, that becomes a new application so that it can be plug and play for other users, saying, hey, Confluent's already been set up, established with these different platforms, with these different data houses. Now we can easily, roll that out for the next customer. So it's a lot easier to play it out. So that does sort of create a network effect or network advantage that would be much harder for, let's say, a new player to come in and actually compete with them, because a new player wouldn't have all these data connections that they've already established. And so, this is clearly, and you could understand why there's a lot of excitement around Confluent or CFLT stock, which is that they're saying, look, we're growing at a good rate and we're tapping into this huge, enormous market opportunity, saying today it's 50 billion, could be 90 billion in the next few years. It's growing quickly. So when you look at their current size, which is only a couple $100 million in revenue versus 50 billion of market potential, they're saying this is easily a 10x potential in terms of their fundamental business size. That said, I always want to understand the valuation as well as fundamentals, so we'll talk about that in a second. So a key aspect of this business model is their open source history. And so they talk about how our open source roots are a key driver of our go-to-market success, particularly Apache Kafka, which is the open source tool. And it's been one of the most successful open source projects, estimated to have been used by over 70% of the Fortune 500. Now, you should understand, this is the tool Apache Kafka, which is this open source solution. That's not Confluent per se. So the developer community understands the benefit of complete platform for data in motion. So people understand the value proposition. I've been talking about it for the last few minutes. Software developers within other prospective customers, engineering or IT departments are often very familiar with our underlying technology and value proposition and evangelize on our behalf. So they're saying, look, because it's an open source solution, it's easier for developers to find out about it and want to spread the good word, because they recognize this is so valuable to understand, hey, how is this company operating in real time? Effectively saying, look, yeah, it's an open source solution, but what we offer is sort of this upselling potential opportunity. And so one should think like, okay, the open source solution has been rolled out to 70% of the Fortune 500. That said, Confluent is not in 70% of the Fortune 500. It's in a much smaller fraction, I would guesstimate. And so this creates the potential for an upselling opportunity, which is a question mark. And so their appeal, the way I think they're framing it, at least per on their website, is if you use their Confluent Cloud, is that you get out-of-the-box connectors to the most popular data sources, syncs in the Kafka ecosystem, SQL-based streaming processing. So effectively what they're saying is like, look, remember that chart with the flywheel and recognizing that they've made all these connections to other data platforms. If you use their solutions, if you pay for Confluent, don't just use the open source Kafka solutions, which the founders helped create. If you pay up for Confluent, you don't need to reinvent the wheel. They've already established those connections with the most popular data sources, creating, the systems in order to track this data. So you don't have to redo all this. There's always going to be projects for, R&D, for developers in-house. So instead of reinventing the wheel, use what they've already established. That's really the way I'm reading it. If you have inside perspective on how you think, Confluent operates and their business model, I'd definitely love to hear it. Feel free to leave a comment below if you think there's a different angle to this than what I'm reading here. And so, I always want to understand, is a company unrivaled, and particularly who are they competing against? And so as they call out their competition, they talk about, various different stages of where the data is stored. If it's on-premise, it's primarily competing against IT teams. So the teams that are working for the individual companies that are attempting to do it themselves using open source software. So when I see that, that does make me excited. So that's, the last time I saw something like that, that was Palantir, where they were saying, hey, most of the time it's companies trying to do it themselves, and oftentimes it doesn't work. So I recognize when you're competing against in-house solutions, that can be a great solution. But this is primarily their focus on on-premise data. So data that is stored on the servers held and owned by the company. But what about cloud solutions, which is where you're paying for the data usage and paying for, it being stored elsewhere? And so, well, when you compete against, when you're competing from a cloud perspective, then you start competing with the well-established public cloud providers, because you realize that these cloud providers really are partner frenemies, because you have AWS and they have their own stream solution. You have cloud data flow with Google, and you have, Microsoft own solution, the Azure Event Hubs. So you realize that everyone's trying to get into this space to compete. And so this is by no means, unrivaled the way I'm looking at it. You have the public cloud providers trying to compete with you, and then you have sort of the legacy providers trying to get into it. This might be sort of hard for them to do, but Oracle Cloud is, Oracle's a big company, and they're trying to get into this infrastructure streaming, Cloudera, Tibco, Red Hat. So you can see there's a lot of players trying to get into this sort of data in motion market that one could argue Confluent was one of the early players sort of establishing. So what about valuation? Here it is. I'm going to do a quick plug because valuation matters. But also, if you're interested in following my personal financial journey, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. Also during the month, I call out at least one potential multi-bagger or type of stock that I think can go up potentially hundreds or even thousands % over time. Also, if you enjoy learning about companies like Confluent, whether or not it's a new IPO or just a stock that I think is interesting, potentially compelling, with potentially dramatic upside. Sometimes I call out videos where I'm like, yeah, this company has 200, 400% upside. I mean, earlier this year, I called out Facebook where I was like, hey, maybe this is 200% upside. Stock's up 40% since then. So if you do enjoy this type of content, please make a point of subscribing. If you're already a subscriber, I do appreciate the thumbs up. Full disclosure, I do own a little bit of Facebook stock. And so let's dive into the valuation as we understand Confluent, because valuation matters. And so as we look at this, first of all, one should understand this is just another hugely unprofitable IPO. And that is the environment that we're in right now. I mean, this is in 2020, 236 million in revenue, 233 million in losses. I mean, that's incredible. Nearly 100% loss as a percentage of revenue. So they're, despite the fact that they have very sizable gross profit margins, and their subscription margins are very lucrative. So you have effectively two revenue sources. Services is usually some sort of implementation where people it's extremely low margin, but their subscription, that's the software. So that's going to be very high margin, 70-80%. And yet they have to invest significant amounts in sales and marketing. So that when I see, wait a second, this company is losing a ton of money, and they're investing a ton in sales and marketing, and they're growing about 50%, maybe a little bit more, 50-60% year over year. It sort of makes me wonder, about that comment earlier about like, oh yeah, because we're open source, it sort of creates these developers that are evangelizing on our behalf. And I'm looking at this, I'm saying, wait a second, you're growing 60%. 60% is a good number, don't get me wrong, but it's not like this is $1 billion revenue company. It's off of, relative to what I've been able to see in some of my other videos. I mean, 60%, it's nice, don't get me wrong, but it's a $200 million revenue business, 60% growth, and they're still investing a ton of money for sales and marketing. So that sort of goes against, like, yeah, you can talk about evangelizing, but I would expect to see a lower sales and marketing figure and maybe just some inherent profitability. And so, you if you're going to value this company and get interested in it, you're going to have to say, well, wait a second, what could their margins be longer term? And this comes down to thinking about their unit economics. What are their gross profit margins? What are they going to be investing in over time? And so I look at this, and first of all, I think it's appropriate to have a word of caution because I've done a couple of videos on different IPOs, some of which I've liked more than others. For example, I recently did a video on Doximity, DOCS, where I actually thought, it was a very interesting company, and I thought the risk reward was certainly more compelling than this company, Confluent, CFLT Stock. And so I'm looking at this, and I think investors should be aware, and I'm going to do a whole separate video on this, which is that stocks are just like any other commodity in that there's a supply-demand aspect to it. And that right now we are in an environment where there's a lot of demand because interest rates are being held low, but there's a lot of supply coming online. And you see this in every market cycle, which is that you have just, when things get hotter and hotter, you get more and more supply coming online. And honestly, you get it at either really crappy companies or you get really expensive valuations come online that really would only happen because things get so frothy. And I think that's exactly what you're seeing here. I'm not saying this is a garbage company. I'm not saying that Confluent falls in this. I am saying this goes into this is a frothy market and people are way overpaying what I think is a sensible valuation for this. And let me show you why, which is that, as you look at this valuation, as you look at this setup, it's currently around $50 a share, which is still a pop from where it was originally, estimated price in terms of getting it, the opening price. It's still around $13 billion valuation. Now, to put that in perspective, maybe this next year, if they grow somewhere between 45 and 55%, that's, 13 billion versus 300 million in revenue. You're talking about, 35 times to, let's say, 40 times sales, not profits, sales. And these are huge. It's hugely unprofitable now. So you effectively have Mr. Market or Mrs. Market, however you want to frame it. The market is effectively saying, we give full credit to future profitability of this business, and we are assuming not only full credit on future profitability, but also a ton of growth in the future. And so here it is in my, this hypothetical valuation framework. This is what I like to do when I look at every company, because I want a logical framework to consider, like, is this worth buying or selling? And that's part of my value proposition for UnrivaledInvesting.com Journey subscribers, where it's like, hey, I'm trying to find logical frameworks where on my low side, I think there's upside. Like on my low case, I still think there's upside. And in my high case, I still think there's a lot of upside. Heads, I lose a little, tails, I make a bunch. And that's what I'm interested in. I'm not interested in heads, I lose a ton, tails, I lose even more. And I think you kind of see that sort of setup here, where it's just not that attractive, in my opinion, where implied growth this year, 45 to 55%, long-term profit margins of 20 to 30%. Maybe it could be higher. I'd love to hear your thoughts on that. Over the ensuing 4 years, somewhere between 30 and 40% annualized revenue growth in the ensuing years. And honestly, if I had seen, they're spending a ton on sales and marketing and putting up even faster growth, then I'd say, like, oh yeah, this number could be bumped up higher. But the fact that they're spending 166 million on sales and marketing, and it's not really translating into like 100% revenue growth, that is a little bit concerning as I look at these figures. And so I'm looking at that, thinking about what could this be valued at 5 years from now, based on this sort of optimized margin that they could potentially do at maturity. Not even 5 years from now, maybe it's longer term, but it's being valued off of that long-term margin perspective. And so I'm saying 25 to 35 times sort of optimized earnings multiple, in which case, in my low case scenario, which honestly, this isn't bad figures. Like I'm saying 20% profit margins, 30% annualized growth, and a 25 times multiple. I mean, in many ways, if you have any sort of change in the market, this might be viewed as an upside. And so here it is in my low scenario, I'm effectively saying 70% downside. My high case, I'm effectively saying down 7%. So I just don't see this as an attractive risk reward when I'm seeing negative across the board. If you're involved in Confluent, I'd love to hear your thoughts on what assumptions you're using and how you get to better figures and better potential outcomes. I recognize different people are playing different games. I try to, come from a rational investing perspective, saying, hey, here's a logical framework. Other people are playing a momentum game and saying, hey, let's up, it's going down, let's short, or up, it's going up, let's buy it regardless of fundamentals. I like using fundamentals because over time, over a multi-year perspective, things generally go to a reasonable valuation. And so this, in my mind, this is a perfect example of why valuation matters. You can't just go watch someone say, hey, this is a great company, should this be part of your portfolio? Like, wait a second, what's the valuation, folks? You always need to consider that. And honestly, this is part of my concern with the broader market right now, which is that there's a lot of just froth out there. And when you own a stock like Confluent, you're effectively baking in this assumption that interest rates will not go much higher in the future, because interest rates versus unprofitable business models, they don't play well together. And so that what ends up happening is, higher interest rates means that future profit that you're going to get 5-10 years down the road, that gets discounted significantly. And then in which case, the stock valuation for these, high growth, significantly unprofitable business models, it starts dropping like a rock. So if you're owning this, you're effectively making a bet on interest rates over the long term. And also, I would argue you better buckle up, because the assumptions that I laid in there of, let's say, 20 to 30% operating profits over time, that's a big assumption. And that in and of itself creates a ton of volatility, because investors say, well, wait a second, is it actually likely that they're going to hit on these numbers? And one quarter, it might not seem like they are. And that maybe you could say, oh, it's only ever going to do 5%, or maybe it'll only be 10%, in which case the difference between 10% margin and 20% margin, that's a 50% cut in valuation. So I'd say this just enhances the future volatility that you could expect with the stock. That said, the valuation range that I provided, look, of course, stock prices can go way higher or way lower, but that's why I wanted to use a framework. Because look, the market can be irrational, people can get animal spirits, but I personally want to be grounded in logic. If this video on Confluent, my warning about their valuation, that said, an interesting business model, quite possibly delivering a lot of value for these companies, that does strike me as a strong value proposition. If this video has been helpful for you learning about CFLT stock, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.